Good afternoon, everyone. Thanks for joining me once again on this brief update on where we see things in the market and just everything that's going on at the moment. I hope yourselves and your families are keeping as well as can be expected, and hopefully by the looks of it, in the next couple of weeks, we'll all be able to start to get out a little bit again and start to have a little bit more normality. So hopefully there is a bit of light at the tunnel and not too much further to go. But I thought once again, like last month, and I actually can't believe it's already been a month, to basically, go through what's happening in the world and to really give an update as to what we're seeing. So I'm just going to bring up my screen here, if you just give me a moment. And hopefully that should have come up there for all of you. All right. So obviously, as usual, what we're going to be talking and going through today is just very general in nature. We're just going to be giving a bit of an overview as to where we're seeing things. So really, what's been happening in the past month? What we've basically been seeing is, a few different things. A lot has happened in the month. Obviously, as we all see on the news with cash rates, the easiest and first and foremost thing, they've come down to record lows. So in that past month, we've gone from 0.75 to 0.25. So, very rapid change. And the RBA has said that's as low as it's ever going to go. So that's where we see things from that perspective. The RBA as well has started quantitative easing, so they've enacted this for the first time in Australian history. And what this is basically then giving us is, a total new world in the sense that what this quantitative easing basically means is that, they're pumping money into the Australian system. They're going to be buying bonds and putting money out there to keep the economy ticking over and keep firing on. From the market's perspective, we've seen the S&P 500, so that's the top 500 stocks in the USA. They're down approximately 15% from their record highs, which were reached in February, just before the virus hit. The ASX 200, so the top Australian 200 businesses, they're down approximately 25% from their same record highs just before the virus in February. From the US point of view, in terms of their unemployment, obviously we've had a few, but US has been quite phenomenal, with still so much more to go. The 26 million jobs just in the last month have been destroyed. So that is basically, more than the Australian population has lost their jobs in just 1 month alone. Add that to their current 7 million who are already unemployed, and it's obviously just quite staggering numbers, and they're just still going to be filtering through. There's still so much more to play out with that. So yeah, some pretty key things that have happened just in that past month. Now, as I mentioned, the American market, okay, it's down about 15%, but if you'll recall, when I had the last update, that was just after it hit what we now at the moment see was the bottom of this current cycle. So on March 23rd, the decline was 37% from its record peak, and you can see that in that little snapshot there of the graph. But since then, the index, so the top 500 S&P 500 index there, they've taken back over 20% of those losses there. So a massive turnaround in only what has been a month there. And I'm sure you would all account to think, well, as I've put up there, has Wall Street gone crazy? And I pulled that from an article that I actually saw just the other day. So it's quite phenomenal, because obviously nothing, fundamental has changed, but we're still having this massive rally as if everything's going to be going back to normal, in the next couple of weeks. As a bit of context too, so the S&P 500, they had its best week since 1974. So it's just been some pretty staggering numbers and turnaround. But, we don't want to be getting ahead of ourselves. The share market hasn't necessarily returned to its bullish ways. If we, look at the numbers a bit closer from the US side, what we've basically seen is that the FANGs, so the big tech stocks, Facebook, Apple, Amazon, Google's, etc. They're the ones that are carrying the load there. They have been, quite, I guess, one of the beneficiaries apart with all of this because of the type of businesses that they're running, the online services, Amazon in terms of whether it's watching their streaming services or using the parcel services and their online stores, all of them, that they're still holding up well, and they have bucket loads of billions of dollars, sitting in the bank to ride out any of these storms. But there's still, as I said, a long way to go. Earnings reports are only now starting to come through, and although they won't be encompassing the full impact of what's been happening, because they'll still be a bit behind in terms of the numbers crunched, that it'll give us a bit more of an idea of just the true impact as to what's going on, rather than the guessing game that's really happening at this stage. The other thing to take note is that the share market pays little attention to the present and almost none to the past. So share prices are an expression of investors' expectations of how the economy is going to be looking in the next X amount of years, whether it's a decade or even longer. So it's more forward thinking and less emotive than what we as individual investors would be. So we do need to take that into account, as well as the fact that we've got record spending by also the US government in terms of propping up their economy. So people are taking note and taking direction from the Federal Reserve and the trillions of dollars that they're spending to really, I guess, get a gauge as to what lengths they're going to go to keep their economy propped up. So COVID-19 around the world, I brought this projection, you could see a month ago, and now it's just gotten even bigger. It's getting so big that I can barely fit it on the page anymore. You can see that Australia has just done a phenomenal job in reducing and flattening this curve that they also speak about. We can really see there that it's only been a couple of extra cases each day now that we're getting, whereas the likes of the USA, for example, they've just hit the million person mark in terms of infection. So obviously a lot more widespread and a lot bigger problem in other places. So I think we're definitely being very lucky in that sense. And as I said earlier, with all this being happening here, I think we can more safely get back to a bit more normality than the rest of the world a bit sooner. So definitely some positive signs there. As I mentioned, infection rates have reduced dramatically. Our testing per capita is fantastic, so it's very high, and the positive percentage rates are very low. In terms of our active nationwide cases, so we've got to think about people that have been diagnosed, but then also recovered. So once you take the recoveries out, there's only about 1,060 cases active right at this stage. So obviously, in the grand scheme of things, it's very minimal, which is great. With the US, you have different infection rates across different states. So you're having mixed messages there, and different governors, etc., that are opening at different rates. Obviously, places like New York, San Francisco, much higher density. The infection rates, obviously are quite high, and they're going to remain in lockdown for quite some time. But you're starting to get a bit of social unrest there, but also in Europe. And, we just saw, if anyone noticed on the news, that Spain was just allowing their kids outside to exercise for the first time in 6 weeks. So they haven't even been allowed to go outside. Just shows how much, I guess, stricter their lockdowns have been in comparison to here. So what's coming ahead? So we've got a big week ahead in share markets. 34% of the top 500 businesses in the USA are going to be reporting this week. And that's going to include some major tech names like the Amazon, Apple, Microsoft, etc. So some pretty decent things to come out from that. The S&P 500 earnings are expected to drop 16% this quarter. So we haven't even seen that since the GFC. And then they're expected to drop at 32% for the next quarter. So it'll be interesting to see how these expectations and the realities line up. And that's going to be a big driver as to the direction of the share market in the coming weeks and months. The US GDP figures, so that's the gross domestic product, basically how much their economy is producing. That's going to be coming out this week, and expectations are for about a 4% quarter contraction. So that's obviously a very decent number there. The next quarter would be then the big one there, because you've got to think that these quarters, the last one was just to the end of March, where things only just started. So it's really the next quarter that we're going to see the full brunt as to the effects of all of this. As I mentioned as well, coming back to Australia, the National Cabinet, they're going to be meeting in 2 weeks' time. And as I said, highly likely to lead, well, more so here in Victoria, for easing of some restrictions. We've seen that the other states are getting a lot more, freedoms put in place. We just saw that New South Wales this morning announced that any 2 people can go and visit any others in their private households starting this Friday. So that's obviously a great thing for people who want to be going to go see their family and friends and what have you. That's obviously been quite a while since they've been allowed to do so. From the portfolio point of view, just to give you a bit of an update as to some movements and some of our, I guess, insight as to what the investment team are doing and how they're going about things. As we mentioned, firstly, we're looking at rotating more defensive type of companies who we feel can outperform and hold up better in these times. And that comes into the light of the things that we've bought there. You can see the things like Coles, Wesfarmers, Unilever, which makes a lot of household goods like deodorants and things like that. You'll turn on the back of the things that you buy on Safeway, and you see a lot of products that are made by them. Fortescue and Transurban. So there's a few businesses there that we feel that, as I said, they're either more defensive or we feel that they've probably been battered a bit too much. We're definitely increasing cash and cash equivalents right across the board. So building up our war chest and having that capital preservation as our priority still. We've sold a few businesses too that we feel are going to go through a bit of a rocky patch. And then, as I said, they're going more into cash or into those defensive type of companies. As I mentioned, there's still so much to play out. We're only now just starting to see the numbers trickle through. So we really need to have this wait and see approach. But history tells us that lows are always, retested over the short to medium term. Never in history, in terms of bear markets, have we seen just one dip and then, oh, that's it, we're back to normal. There's always been at least, 1 or 2 more dips to come. So it will be interesting to see if we retest the lows from March. We had this up last time, just a bit of a reiteration on the value of asset allocation, active management, and obviously why it's important that we do what it is that we do. So when we have defensive and growth assets, we need to have a good balance there between assets that are going to be more risk prone and ones that are going to be more stable orientated. They all have their own characteristics, and we need to have, I guess, a bit of a mixed basket when it comes to that. Direct holdings, so we're talking about liquidity, security, transparency all the time. As you all know, we're very big on those things. We want to make sure that if you need cash, you can get it quickly. To have the security knowing that no matter what happens to our business or your situation or whatever it is, you are the direct beneficiary and owner of the specific units in the holdings that you have in the portfolio. As we mentioned, big names, big balance sheets, okay? So we need to be with resilient, well-managed businesses with a lot of cash at bank so that they can thrive through this once the worst is over. It goes back to the Apples, the Googles, CBAs, etc. These are the big businesses that are holding up the indexes right now because they have got plenty of cash to get through this, and they are the ones that are adapting the best, and their services and products are the ones that are going to only accelerate in demand as we basically push ourselves into more technology focus of how we interact and how we go about our daily lives. Tactical tilting, so we're talking about actively maneuvering the portfolio, and we've been doing that ever more so recently. You would have seen communication from our investment team that we are all about making sure that we can have the right amount of cash or shares at any given time, and we need to have the ability to pull those levers when it comes to cash and how much we hold, etc., and to move into certain companies at a much more rapid pace, so that we can adapt to the current climate and not to have, I guess, a clunky and lagged response to what's happening. Now, all that means is that we can see, all right, well, how does that translate to the portfolio returns in terms of ourselves and also, I guess, against the benchmarks there. So this is really, you know, the benefits of active management coming into the fore there. So we can see now these are obviously the stock standard portfolios with no adjustments there. So whether it's conservative, moderate, balanced growth, etc. You can see the FYTD, so the financial year to date, versus the benchmark there, which is benchmarked against a ratings company called Morningstar. They have different companies that we peer group to make sure that we have a like-for-like comparison to say, okay, well, you know, say for example the growth fund there, our growth fund, okay, well, it's a negative figure for that quarter because it's for the end of March. It was down 4.57, whereas the benchmark was down just over 10% there at 10.03. So there's a good 5.5% difference just in that short quarter there. So it does highlight that being you know, able to maneuver and to have a tactical and active management is definitely going to be beneficial to people, because when these things are just changing by the hour and by the day, we need to be able to maneuver as best as possible, and it shows there. So look, that was everything that I wanted to cover today. Obviously, we keep hoping to, you know, keep you up to speed with as much as what's happening out there. Obviously, I'm speaking to a lot of you individually, and you know, please don't be afraid to just pick up the phone and call or send an email. I guess we're a bit reactive at the moment with people just calling and getting in touch, and so please don't ever feel that you're being neglected. By all means, just pick up the phone or send an email. Otherwise, all the best to yourselves and your families. We hope that you're still holding up well, and that, as I said, in the next couple of weeks, we get a bit of a reprieve, and we can stay on the upward trajectory with everything that's happening. Thanks again, and take care.